company
Yes.
law.
We had a conversation talking about taxation of individuals, right?
Okay.
That is individual or personal income tax, right? Income tax. So we explained that individuals raise their income from savings. There is that savings income. There are those non-savings related. There are different forms of incomes that people receive, rent among others. I think we had that conversation where we were just basically studying how the income of individuals is taxed, right? Yes. So in the previous conversation, we extended the hand and talked loudly, especially about how the individuals, the hands of the incomes of individuals are taxed. Now, it would interest you to learn that the same way how individuals are taxed, also the employees are taxed. That those are the same rules that apply because individuals and employees are the same people. They receive income from employment. Others. Okay, so that was the same conversation. Now, the partnerships. I'm laying a foundation. I want you to follow nice. Also, when it comes to the partnerships, right? The partners. You know what happens with the partner or with the partners is that they are taxed individually. You don't tax the whole partnership together. So you just tax them as individuals. So that simply means the way how you tax partners, you just tax them as individuals. So partnership taxation is already covered as well. Right?
Yeah.
So proprietorship. The businesses that are run by only one person are taxed they tax the owner, the individual. You get the point? They tax the individual. So that's what is there. Now the conversation is becoming more interesting when we lift it up and bring it to this note. And we are talking about now companies, the limited companies, right? Which are basically separate legal entities, according to what you learned in the laws. You learned that corporations or companies are basically separate legal entities. They're basically individuals or persons in their own capacity. Yeah? They are artificial persons. They have capacity to sue, and they can also be sued. I want to just record that. Yeah, they have capacity to sue, and they can be sued. They have capacity to stand in the court of law and defend themselves, or they can also go launch complaints like that as a company. So basically, that's a background to the conversation. Now, how do you tax companies? I should be quick to indicate to you that the taxation of individuals or sole proprietors, it's almost similar. The rules almost they apply, right? When it comes to the corporation taxes as well. There are just very few differences that you're going to notice. Why? Because the corporation, it is taxed as an individual on its own. Not they don't tax the owner, no. They taxing the company itself, not taxing the owners of the company. You've seen the differences, right? In sole proprietorship, we target the account of the owner. Similarly, in partnerships, we target the owner, the owners, the partners. Yeah. But when it comes to the corporations, we don't target the individuals. We target the company because it is a person on its own. You get the point, right? So the rules that apply to individuals do also apply when it comes to the corporations. Any questions?
No, sir.
There are no questions, right? What are some of the rules now that apply and how do you compute? So the key thing that I want you to walk away with when you talk about corporation taxes, number one, we want you to know how to calculate the taxable profit. You get it, right? This is the most important thing.
Taxable profit.
Taxable profit. Because what will happen is that companies are going to be reporting taxes. As I am sharing, you find that companies are reporting the profit, but that same profit need to be adjusted. Why? Because in the expenses on that, when you go to the expenses section of the profit and loss statement, remember there's a part where they put expenses, yeah? Down expenses, there are some of the expenses that don't qualify to be called expenses. For example, depreciation. You remember I said depreciation doesn't qualify to be an expense. Amortization, and many other expenses that don't qualify. So, which means that those will need to be added back to the profits because they had been deducted as the expenses, right? You got to add them back so that they can expand or increase the taxable profit. So you will see that there are adjustments that are made. The company submits, but also the taxing authority will need to adjust that tax, that profit. Okay, looking at the statement, they will adjust it and make sure that it sits very well.
Okay.
So now, when you adjust, those adjustments are the ones that will help you to come up with what we call taxable profit. It is not the profit that the company reports. No, there are some calculations that are done by the taxing authority to just make sure that they come up with the taxable profit. Okay? You need to know tax liabilities. How do you come up with tax liabilities? Then there are what we call capital allowances. I think we had a conversation on capital allowances on just the whole topic was on capital allowances.
Yeah. It's the same way we calculate it, huh?
Exactly the same way. So now we factor them in here. Yeah, there we just looked at them as capital allowances, but we didn't show how they affect the profits, the taxable profit. So now we are showing you how these capital allowances affect the taxable profit. And when we do with all those stuffs, then we should be fine. Those are okay. Those are major things that even if you are not to get, but you should get this, right? These you should get them. Any questions?
No.
At least you've gotten the background, the introduction, and we can get started now. Now, we have already made mention that when you are going to be computing this corporate tax, right? The corporate tax, there is an act that is being used, and this one was of 2009-10 and 1998. These acts are in the laws of this is the UK law. You don't really need to go down and start them. Yeah, but if you have time, you could go. Yeah. So now, the key message is this one. Income is generally computed in the same way as for individuals who are trading or sole proprietors. You get it, right? The way how you compute income under sole proprietors, yeah? In the similar manner, you shall compute the income for the corporations or the corporate tax. Okay?
Okay.
So when you take that form, you should be able to get it on what we mean by who is liable to paying corporate tax, who can pay taxes. Corporate taxes are paid by corporate bodies, the companies, yeah? The corporations. The corporate bodies. An incorporated association would include the clubs and societies. These, they can also pay tax.
Yeah.
Okay. Then, these are clubs, the societies. The residency in the United Kingdom, those that is those who are incorporated in the UK, like the companies which are incorporated in UK or within the country, In case of Zambia, those that are incorporated in Zambia, say, for example, incorporated by the Patents of Companies and Registration Agency, PACRA.
Okay.
Or if these are rules, the central management and control is exercised from UK. That company can pay tax in the UK. It might not have been, it might not really have all the offices in the UK, but if the management, like the headquarters, are in the UK, they have to pay tax. Okay?
Okay.
So now,
Yeah,
here's the message. The message is the charities, the trade unions generally are exempted from corporate tax.
Okay.
That you have to take note. The charities, the charitable organizations, the trade unions, they are exempt from this corporate tax. They don't pay corporate tax. Okay? These are just the rules that we need to use as we will be calculating when time cometh. What is corporate tax charged on? You know, the total taxable profits for an accounting period, for example, would be all the profits that are earned anywhere in the world. That should include the profits and the chargeable gains. So that is to say the profits of the branch office set up in the USA are taxable as the trading profits as well. So as long as there are trading profits, regardless of the location where the trading has been done, okay, or yeah. So the gains on the sale of the plot of land in the other countries, those are gains that I was talking about. Those are chargeable gains. We explained about chargeable gains, right? I think it was our last slide in our last unit. So all those, they are chargeable. They are part of that. How do you come up with that profit now? The chargeable profits, corporate tax. How do you know? Listen, there is what you call the trading income. This is the income that you have raised from trading. This is a format, by the way. You are to less the trading losses that were brought forward from the previous period, and then the last balance, you push in the last column. Then you put the income that you get from land and buildings, that's from property. You write that, that's the format. The surplus that is found from non-trading loan relationships, the non-trading income from intangible fixed assets, like those fixed assets.
Okay.
The miscellaneous income, the incomes that you just get, like small incomes from other stuff. Chargeable gains. Yes.
We move on. Is trading income profit of the year before tax?
Yeah.
It's known as trading income, yeah? Profit for
trading
the year.
Income. Profit before the year.
No, profit for the year before tax.
Yes.
That's trading income. That will be like, you know, they give us a question to find this, yeah? To find the total taxable profits. So the profit of the year will be a trading income.
That trading income, that is PBIT, like profit before tax. Sky, if you have already paid the corporate tax, then there's no need of, you know.
Okay, yeah, makes sense.
Of calculating for tax again.
Yeah.
Then you deduct the capital losses, allowable capital losses from capital allowances that we talked about last time. Then you have all your workings. You less now the following: the property business losses, if you lose some property businesses, trading losses that are brought forward from the previous period deducted. Yeah, but the issue is this one. If you had already deducted from the previous period, this one, then there's no need of deducting again.
From where? The capital losses?
Yes. Now look the way how the instructions are. We want you to pay attention. You less trading losses from before. This is brought forward from the previous period. Then the trading losses from on or after. These are losses after the period, after this opening period. These are the losses that we're talking about.
Okay.
There are two losses. There are losses that you got previously, and there are losses that you get afterwards. Now, deficits or non-trading loan relationships, you put them there, right? And trading losses relieved against the total profit. The qualifying charitable donations, if you donate to the charity, you deduct that because those are allowed, Those are allowed the deductions, right? And you consolidate all those, their total is what you put here. Yeah, then you deduct from this figure. This is what you have as a taxable profit. Remember, it's one of the objectives of this conversation. I said you should learn how to come up with the taxable profit. How did you come up with taxable profit? Basically, that's how you go about it. Any questions?
No.
So the format is to be memorized.
Okay.
Yeah. Now, profits chargeable to corporate tax. So now a company cannot be an employee and it cannot have employment income, isn't it? Yeah. So there will be no that part because we said that the rules that apply to individuals, they apply here. But when it comes to individuals, they also have employment income. Huh? But the corporation is not employed, right? There is no corporation tax allowance of the personal tax allowance which are available to individuals who pay income tax. And then it is said that the trading profits that we are looking at in corporations are similar to those under sole proprietorship or under individuals. Okay, we're talking about the elements of chargeable profit. What forms chargeable profit? The income from UK land, buildings, or from property, or similar to individuals, but some differences. That's for that income that you get from land or from building, from property. Net surplus or non-trading loan relationships, for example, of course, that is riding on the accrual basis. The miscellaneous income, that is, those one-off projects,
Yeah.
Yeah, one-off projects that are not really like the normal trade. Like it just happens once. Those are what you mean by miscellaneous income. Chargeable gains and the charitable donations. Now, when we have all these put together, then we can look at an example. The limited company has drawn up its accounts for the year that ended 31st January 2025. The information relevant to the tax return has been extracted from them and is given as follows. You got to calculate the profits chargeable to corporation tax. Calculate the profits, calculate the profits, calculate the profits, calculate the profits chargeable to corporation tax.
Yeah.
The trading profit that is adjusted for tax purposes is that the rental income is that the bank interest given and gift aid donations. The gift aid donations as 60,000. We are to do the profit that is chargeable to the corporation.
Yeah.
Yes. How do you deal with this? That is where the question is. So to start with, remember we need there was that first the profit before interest and tax. That is the trading profit. The 750 is what you start with, right?
Okay.
Then to it, you're going to add all the other additions, right? The other addition. And then you less all the allowable deductions. So the other additions that you could include is the income that you got from property, the rental income. Remember, rental income is also part of it's part of that income, right?
Yeah.
From trading. And then once we add the rental income, you look at the hello?
Yeah, continue.
There's this bank interest receivable. The bank interest receivable. What is this one? The bank interest receivable. What do you understand by bank interest receivable?
It's like the interest you receive like as an extra income, like, you know. It's non-trading income, basically.
Yeah. So that's that. So that's a surplus from non-trading, because this is non-trading, you know, trading loan relationships, those interests.
What do they mean by don't gross up for companies?
Like you don't say this is gross profit, or like what we mean by don't gross up for companies. You don't say this is the gross profit after you have added all these things. Why don't you gross? It's because, remember, gross profit simply means the profit that you get after trading, after trading, main from trading accounts. But some of the income that you've gained is not from trading. You understand, Look, gross profit. Yeah, you've picked it, isn't it? Gross profit is in the trading account that, according to accounting.
Yeah, they've already calculated and everything.
Yeah. Then when you consolidate everything, then you can less qualifying what? Donation. So the rules are that, to summarize it, the taxable profit on top, then you add all these other incomes, add all these other incomes that are from the non-trading incomes, you add them. Then from them you can less all the qualifying what? Deductions, including the donation. Now this one, remember, it was a gift aid. It was an aid donation. There are some donations that you could put here that don't qualify for that. Yeah, but this one is about helping. So it's a part of charitable, it's accepted. You could report that amount. And then you deduct. From there, you have the taxable profit. Basically, that's how they come up with taxable profit. You got it?
Yeah, I've understood.
So now we have met the first objective of the conversation, to know how to come up with the gross profit, right? Maybe the other question would be, how do we determine the accounting period of corporate tax? Now, it starts when company starts to trade. Okay, that is when the company becomes the resident. All right. Yeah. Usually for 12 months. That's the period. So if a company starts, for example, trading in April, right? That will be the case. It will be for 12 months from there.
Okay.
Yeah. The accounting period is not supposed to be more than 12 months. It's just 1 year. So a company therefore prepares accounts, as an example, for the period 1st January 2023 to the other year, 31st March. What are its accounting periods for tax purposes? What are the accounting period for tax purposes? Yeah, when should they pay tax? in other words. So now, you have to understand that when it comes to the payment of what is this tax, right? It depends on how should I say, the size of the corporation. I'll come back to the second message. The corporations that are able to make, for example, in some countries, like for example in Zambia, more than 800 kwacha, like those can pay yearly. They qualify for income tax. But the firms that more than 800,000, not 800,
Okay.
800,000.
Yeah.
But those that have 1 million and above, yeah, they are the ones that qualify for income tax. But those less than 1 million, they qualify for corporate tax. They do qualify for corporate tax. For tax turnover tax. Yes, turnover tax.
Okay.
Yes, they do qualify for turnover tax. Now, for example, now we also have to look at how one could, allocate income to accounting profits. Yeah, how one could allocate the income, to accounting profit. That is, for example, if the period is long, of course, for 1 year, is being broken down into 2 separate accounting periods for tax purposes. Okay, then you got to allocate each separate element of income in those small divisions. All right. That is if the period is very, very long. We could break it down into 2 separate accounting periods.
Okay.
Okay. So now, when you talk about the breaking down of the period, we could have an example of this company has made up a set of accounts for 18 months. This is what we mean. 18 months, which is 1 year and 6 months. You get what I mean, eh? 1 year and 6 months from January to the other year. So the trading profits are given as that. The rental income is given as that as 500 per month from January 2024, right? January 2024, which makes it from 2024 January to June. That's 6, yeah? So you say 6 times 500, that is 3,000, right? That is how we get to have that 3,000 from rental income. The capital gain in May, yeah, from the disposal of an asset was 250,000. Then the gift aid donation that was paid last year, 2023, December 31st, was 50,000. And the required is to show, the division of all these accounting periods.
Yeah.
So obviously from rationality, we could know that first you have to do for the first year, then you do for the other months. For the other remaining months. Anyway, let's go ahead. So you get to have the trading profit, of course, for this we put together. That is for the period that is January 2023 up to 30 June 2024, the other period. Okay, let's start with this. You put the trading profit, add the rental income, because it's that, including the chargeable gains, add together and less the qualifying donations, like the gift aid is deducted. That's what we say. So for example, now, here is how you could still go about it. You could still break down, that's the message we are trying to say. Yeah, there is the example is just, they just put everything together for a period, but you could break down, like you just consider for the first year, for the first period, the first 1 year and the last 6 months, put it together, and then you report. You
Yeah,
get
the
what I
thing is,
mean?
I think this slide is missing the other 2 columns. I've
Oh, there,
noticed.
yeah,
Yeah, there
there
were
are other,
supposed to be other 2 columns here. I don't know
yes.
why.
So they should have been there that show that breakdown where you show for 1 year and so for the other 6 months, like that. How do you calculate the trading income? Yeah, this is the same thing that I said. I'd already said that it is profit before tax per accounts, like your accounts. Then you add back all those expenses that are not allowable, like entertainment of public, depreciation, and you add back the taxable income not included in accounts. Add back all those incomes like that are not in the yeah, for example, rent, all those other incomes, right? Add them back. Then you deduct expenses that are allowable for tax purposes, but are not in the accounts. Deduct them. Yeah, like capital allowances, deduct them. Deduct profits in accounts that are not taxable as trading accounts, like chargeable gains. Those chargeable gains, we deduct them, right? The chargeable gains are those gains that we have made from this disposing of assets. You remember that conversation, right? That's the format. That's the format that is followed. And then you have your trading profits, which is basically the repetition of the same thing that we have said. Any questions?
No, sir.
Okay. Now, here is the note bene, the NB. The note, we are to note that the accounts that are drawn up to according to the generally accepted accounting procedures or international financial reporting standards are generally valid for tax purposes. Only those accounts that meet these standards, right? That meet the international accounting standards. Okay, they are the ones that should be, what is this? That is where you have to calculate the trading income. Now, when you're calculating a company's trading income, there is no need to disallow the private, proportion of expenses here. Not like the one for individuals. You remember that one where we are saying this asset is being used by private and also as part of the business, right? Yes. So a company's gift aid donations are disallowed when calculating trading income, but are treated as qualifying charitable donation. So you, when you are preparing your income statements, right? If you put gift aid donations in your expenses, they will not accept it. You get what I mean, eh? Because it's not an allowable expense. Okay, when calculating trading profit. So that's why we have to add them back. We have to add them back. Okay, we have to add them to this trading profit, but deduct them later on when we are dealing with the charitable donations because they qualify there for deduction. Okay.
All right.
Those losses that are caused by the dishonest of a director are not allowed. For example, a director made maybe stole something or whatever, those losses, please, you can't report that, no, we made a loss, so this is how much, that's why our profit reduced. No. Yeah. So basically, this is the message that we are sending. Capital allowances have come now. You get it, eh?
Yeah.
Capital allowances have come again. So the capital allowances are treated in the same way as we treated them under income tax. Okay. But the only thing is that there is no private use reduction as companies separate. It's basically a separate legal entity from directors and shareholders. You don't do like what we are doing under individuals. Remember there was a private use section stuff, right? There was that section where we're putting private use. We're not doing that.
Okay.
Now, if you are charging, you're calculating for chargeable accounting period, which is less than 12 months, maybe 8 months. You can use the writing down allowances prorate accordingly. That is where you say maybe it's 6 months, you say 6/12. You remember the prorate method, yes. So basically, that's what the message is all about. For example, we have all these the capital allowance stuff. The balance is brought down. The main pool has 2 million, special rate 3 million, equipments, fixtures. This conversation has just been repeated, you know. This is almost the same stuff that we are looking at the capital allowances, I guess. The main pool, then you start, you know, AAI, the main pool, special rates, no private use, I've emphasized. Writing down balances, value, put them there. Yeah. And the disposals on those are deducted, you have that amount. Then additions would be of the equipments, those are already there. They added equipments. They also added some fixtures at that same cost. But remember the AII, the allowances, the annual investment allowance maximum is 1 million. So they deduct 1 million and remain with only 300,000. Yeah, I guess you remember this conversation.
Yeah, I remember.
And then the percentages for special rates is what? It's 18%.
For main
and
pool.
Then for basic, yeah, it's that 6% stuff. Yeah, all those stuff. And basically that's that. So you don't suffer. Yeah, and then you treat them in the same way anyways as we were treating them those days back then.
Okay.
Any questions?
No, sir.
You've seen that it was not very complicated, eh? You just needed to look at it again.
Yeah.
With all your time.
Look at capital allowances again and then come back to this one.
And come back to this one again. So you would understand that it's the same stuff. There could be some interest that one could gain on a non-trading loan relationships. Yeah, for example, you have the interest that has been received, the interest that has been paid, you know, on overdraft, loan interest, then the trading profit is given like that. So now how do you calculate the taxable profits? How do you do the taxable profit? That would be the question. Yeah. What is interesting to learn is that the non-trading interest, loan interests themselves, number one, they are called non-trading because they are not part of the trading processes. Yeah, to start with. Okay. So you could have the income that was received from the previous period, the interest received this one, the 5,000 one. This is the one. And then you less the one that was paid 2,000, and then loan interest of 4,000. And then what you'll have is you're told to do what? You are told to ignore interest when it comes to the trading profit. What does that message mean?
Ignore the interest already counted in the trading profits.
Yeah. That's what that's. You understand these stuffs already.
Yeah.
Yes. Yeah, so there are all those differences that are there, and you are okay. So interest received minus the interest paid, then the net differences is what you record there, and you're good. So basically, that's that. The income from property, this one is from the sale of those stuff, like the selling of things, and it is also one and the same stuff. The rates, these are rates. We know the rates. Yeah, we could easily read through the rates, the main pool rates, among others. These are rates like for the corporation taxes. We could easily find them like that. Okay. Any questions?
No, sir.
There are no questions. So what you need to do is at your own free time,